Will the Federal Reserve step in to save the stock market if it crashes? That question has loomed large for investors used to a so-called Fed put, the belief that the Fed will rescue plunging markets with easy policy. However, recent signals from Fed officials suggest those days might be over. In this video, we'll analyze why the Fed is warning it won't rescue the stock market, and what Fed Chair Jerome Powell and others have been saying about interest rates, inflation, jobs, and market volatility. We'll also look ahead to the Fed's upcoming policy meeting on May 7, 2025, and discuss what this stance means for investors. Let's dive into the Fed's latest message and the fading of the Fed put. For decades, Wall Street counted on the Fed put, a notion that the Fed would cut rates or inject stimulus if stocks fell sharply, acting as a safety net. But Powell is pushing back on that assumption. In an April 16th speech, he was asked point-blank if a Fed put exists, and he answered no. Powell explained that recent market volatility reflected uncertainty over new trade tariffs, but that markets are functioning, they're orderly, and not in need of intervention. His message to investors was essentially, don't rely on the Fed to bail out the stock market. Unless a market downturn threatens the basic functioning of the financial system, the Fed isn't inclined to step in just because stock prices tumble. In fact, officials note that a sell-off confined mostly to equities hasn't triggered any Fed response. Reuters adds, this is a stark contrast to times when the Fed acted aggressively during true crises, such as the 2020 pandemic crash or the 2023 banking turmoil. The era of an automatic Fed rescue for stocks appears to be over, at least for now. This shift in stance was evident as stocks gyrated recently. Since a trade policy shock in early April, the S&P 500 fell into a correction, down about 14% from its February peak. Amid heavy volatility, investors had hoped the Fed might signal support or rate cuts to cushion the drop, but Powell's response was more hawkish than markets expected. Instead of offering a reassuring dovish hint, Powell emphasized the Fed's focus on its economic goals over market indices. As one market strategist observed, Powell's comments amounted to, don't necessarily rely on the Fed put. We really don't have the safety net for stock investors. In other words, the Fed's priority is controlling inflation and sustaining employment, not targeting stock prices. So why won't the Fed ride to the rescue of Wall Street? Simply put, the Fed has other problems to tackle. Inflation, though off its peak, is still not fully back to the 2% target, and the economy is facing cross-currents. Powell and his colleagues have repeatedly stressed that policy decisions will be driven by economic data, and the Fed's dual mandate, which is price stability and maximum employment right now, that means holding firm on interest rates despite market turbulence. For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance, Powell said. This indicates no rush to cut rates. In early April, he noted, a lot of waiting and seeing is needed in this time of elevated uncertainty, making it clear the Fed won't be rushing to cut rates absent a truly dire crisis. A major reason for caution is the persistent inflationary pressure in the economy. After aggressive interest rate hikes in 2022 to tame surging prices, the Fed began easing slightly late last year. However, progress on getting inflation back down to 2% has slowed in recent months. In fact, new cost pressures have emerged. For example, tariffs on imports imposed in April are expected to generate at least a temporary rise in inflation. Powell warned that these inflationary effects could be more persistent if they feed into expectations, something the Fed is watching closely. Reuters reports that recent data gave a mixed picture. March consumer inflation showed some cooling, but core inflation is still above target. Fed officials don't want to declare victory too soon only to see inflation flare up again. That's why Powell has signaled the Fed's bias is to keep policy sufficiently tight until they're confident inflation is durably back to 2%. At the same time, the Fed is monitoring signs of an economic slowdown. The U.S. economy started 2025 on a solid footing overall, but growth has downshifted. Powell noted that first-quarter growth has likely slowed from last year's solid pace, but there are downside risks to growth. For instance, trade disruptions have led businesses and consumers to pull back somewhat. Despite this, the labor market remains robust so far. Powell said employment is still at or near maximum levels. This historically low unemployment shows the economy isn't in free fall, though Fed officials expect some cooling in the job market as growth slows. Governor Christopher Waller noted that if tariffs and other factors hit growth hard, unemployment could rise toward 5% by next year in a worst-case scenario. In short, the economy is sending mixed signals. solid employment and still elevated inflation on one hand, but slowing growth and rising uncertainty on the other. That mix makes the Fed especially cautious and data-dependent, unwilling to swing policy in either direction until the outlook becomes clearer. Crucially, the Fed doesn't want to stimulate the economy or markets prematurely and then have to reverse course. Powell has cited the risk of making moves that later need to be undone. All eyes are now on the Fed's upcoming policy meeting scheduled for May 7, 2025. Given the Fed's recent rhetoric, what can we expect? Many investors had been hoping that slowing growth and calmer inflation would open the door for interest rate cuts soon. In fact, financial markets are betting fairly heavily on rate cuts by later this year. As of mid-April, futures traders were still pricing in the Fed to start cutting rates by June 2025, with the policy rate potentially about a full percentage point lower by year-end. In other words, Powell is managing expectations by pushing back against the idea that a rate-slashing cycle is about to begin. That doesn't mean the Fed won't cut rates eventually, but it will do so only if the data genuinely warrant it. For instance, if the economy slips toward recession, as Blinder noted, then the Fed will probably cut in that case. So for the May 7th FOMC meeting, the most likely outcome is a policy pause, keeping the federal funds rate in the current 4.25%–4.5% range, combined with a vigilant stance. Powell even quipped that calling such inflation temporary is another word for transitory, reviving a term the Fed infamously used in 2021. In other words, the Fed won't be swayed by political pressure, even as it faces public critique, like recent calls from President Trump for rate cuts. It's a fine line to walk, and the Fed is trying to communicate a stance that is resolute but not rigid. So, what does the Fed's no rescue for the stock market stance mean for investors? The takeaway is that the investing environment may be entering a new phase, one with less of a Fed safety net under asset prices. Without the promise of an immediate Fed bailout, markets could experience more volatility and deeper corrections as they adjust to economic realities. Investors should not assume that a sharp drop in stocks will automatically lead the Fed to cut interest rates or launch new stimulus. The Fed is currently prioritizing fighting inflation and maintaining economic stability over boosting asset values. That means interest rates could stay higher for longer than markets would like, especially if inflation proves sticky. In practical terms, borrowing costs remain elevated, which can be a headwind for stock valuations and economic activity. On the other hand, the Fed's stance also means it is laser-focused on its mandates and will act if truly necessary. If a market downturn starts to seriously threaten the economy, for example, if credit markets seize up or a loss of confidence risks a broader financial crisis, the Fed would likely step in. But short of that, policymakers are content to let markets find their own level. For investors, this underscores the importance of risk management. With no Fed put, factors like corporate earnings, economic fundamentals, and geopolitical developments could have a more pronounced impact on prices. They're not aiming to punish investors, but they want to avoid past mistakes and ensure long-term stability. For now, caution is the Fed's mantra. As investors, we should take note and perhaps exercise some caution of our own in these uncertain times. Thank you for watching. If you found this analysis helpful, please like the video and subscribe to the channel for more updates on the Federal Reserve and financial markets. We'll continue to monitor the Fed's actions and the economic outlook to keep you informed. Stay tuned for our next update, and until then, stay informed and make sound decisions.